Hey guys, Miguel Castro, Castro Real Estate Services. Hope you're having a great day. Hopefully, Father's Day was great for you guys. All the fathers out there, happy Father's Day. I'm going to try to explain what is happening with the valuations on income producing properties, particularly multifamily. I know a lot of you already understand how this works and what is happening, but for the ones of you who don't, let me kind of explain it a little bit here and see if I can do a good job at it. Hopefully you can see the board. So let me give you an example here. This building, let's say a year and a half ago, 2 years ago, was worth $3.5 million with a net operating income of $140,000. So that building was making $140,000 of net operating income. So that was a cap rate of 4%. In some circles, that 4% was acceptable, right? Nowadays, investors are not accepting 4%. They need something higher. So let's look at 7%. So that building, to have a capitalization rate or a cap rate of 7%, only making $140,000 of net operating income. Valuation for that building needs to be at $2 million. So that building just dropped 43%, right? From $3.5 million to $2 million. Lost 1.5 million. That's crazy, but that's the way it is. That's what's happening. So Miguel, why are investors looking for a higher cap rate than what it used to be? It's because they need to be able to pay for that higher interest rate. Let's look at this example again. So this building, sales price $3.5 million. The buyer was able to get 80% loan to value at 6% for 30 years. And that's debatable, right? So the annual debt service for that building or that finance deal, that leverage deal, is $201,000. But guess what? That building is only making a net operating income of $140,000, so it doesn't work, right? So now you have to drop it to $2 million, right? So the same financing terms, but now obviously the loan amount drops because the sales price drops. So now this buyer is getting a loan for $1.6 million for 6%, at 6% for 30 years. So the annual debt service on that deal, it's $115,000. So that's a little bit better than 201, a lot better, especially when you're only making $140,000. So that's what's happening. The higher interest rate are causing these deals to drop in value. So what do we do? Well, let's look at some options. Types of financing. If you go to a smaller local bank, you probably get no more than 75% LTV, anywhere from 60 to 75. Interest rates is probably anywhere from 7 to 10%. And amortization term maybe no more than 20 to 25, right? And keep in mind, some of these deals you're fixed for 3, 5, or 7, and then you have to refinance and you have to redo the deal, and that's another issue that will happen. If you go to Fannie or Freddie, aka agency loans, you can probably do 80%. You can probably get 5 to 7%, 30-year amortization, non-recourse. So these are big players right now, right? But depending on the loan amount. Other options: private equity, bridge, which is very expensive and risky. Insurance companies, auto financing, the mob. No, don't go to the mob. Don't do that. Assumptions. Assumptions are pretty big right now. If you're able to do it, I would definitely look into that. So we get creative, but realistically creative. So that's what's happening, So it's crazy, but so 1% increase in cap rate represents about 20% decrease in value. So hopefully that helps. Comment if you have any questions. Thank you.